Will I just hit present when my bit comes?
You got it. You got
Okay,
it.
thank you.
No problem. Okay, so we are live. We're going to give it a few minutes for everyone to come on in, and then we will get started. We're going to be talking about multiplexes, all about multiplexes. You may have heard some stuff circling in news with policy changes, so we're definitely going to be touching on that. And then at the end, we're going to have our very own Chris Alward from BMO to talk about mortgages and all that. So let's give it a few minutes, and then we will get things going.
How was the traffic coming back up?
Oh, thankfully with the train, no traffic on the train. That's the beauty.
That's good. That's good. It was pretty windy. Blew out everything along its way.
Yeah, we were on some phone calls, and the network dropped twice in an hour. Just complete flatline. All of our calls dropped.
Holy smokes.
Mm-hmm.
The entire lights went off and everything too.
Oh my gosh.
But I haven't been outside, so I don't know what it looks like outside, to be honest with you.
I think it was pretty windy, but I think it has calmed down now.
It definitely was blowing my hair sideways.
I like that.
That was good. That
was
good,
a
Chris.
good one.
Oh man.
Oh boy, oh boy.
Okay. Okay. So a couple more minutes, just a couple more minutes, and then we'll get started. Questions, of course, will be at the end. If you guys did have any questions already for us, feel free to put it in the chat, and we make sure we'll address it at the end of the webinar.
Mm-hmm. Okay, you may want to. What?
Let's get it started.
Okay.
Yep.
Perfect. John, there you go. Thank you. Okay, so multiplexes, and how they can generate great cash flow. So let's get into it. A little bit about us. Those of you that don't know us already, we are the Zadigan Group. We are a real estate firm here in Toronto. Obviously, our main goal is the clients that we serve and getting them from point A to point B in the real estate journey, however that might be, which one of those steps for some of our clients is multiplexes. When it comes to where we service, obviously locally, however, we are national and international for some real estate product types as well, which some of you guys already know. Now, let's talk about the investment ladder. Now, when you're going through your investment journey over the years, oftentimes people will start with condos, then the stacked townhome, semi-detached, detached. Then we get up into the duplexes, triplexes, and then multiplexes, which for the purpose of this webinar, multiplex is going to be anything that is 4 or more units or 5 or more units.
Mm-hmm.
Jonathan?
So let's jump into, what is a multiplex? So a lot of people right now, they may have a portfolio of condos, of townhouses, and they're looking for, different types of properties that can bring in potential cash flows or higher returns on their money in terms of a dividend, per se. So, multiplexes is multiple units with multiple revenue streams. We could be talking about 3, 4, or even 5 unit, multiplexes here. Now, types of multiplexes. What we're going to be diving into today is, starting from if you have a house, you want to buy a house, and you want to add a secondary unit or a basement, finish. You want to finish your basement to generate that additional revenue. Going into a triplex, which is a 3-unit home, could be a semi or could be a detached. Then going into conversions. So multiplex conversions, it could be something that you're buying as a semi, as an example. It could already have 3 separate units, but basically adding value to those specific units to change them from a 1-bedroom to a 2-bedroom, and so on and so forth. Then we're going to get into laneways and how laneways could be lucrative, and then we're going to get into turnkey multiplexes. So these are stuff that maybe somebody had already built, a brand new 5-unit complex, and you're buying it from them. Now, these are in order of, I would say, lowest, capital amount of, capital required, which is a basement finish, to the highest amount of capital that would be required to buy a turnkey property. Now, getting into types of multiplexes again, like we just said there before, these just come, some pictures of, showing, what these type of things, basically are. And, let's get into pros and cons, right? So pros and cons of multiplexes. Ari, you can take this on.
Okay, so the pros. One of the pros of having multiplexes is the income stream that it has. In a way, you're protected when you have a single unit of, let's say, a condo for rent. You have only one stream of income coming through. If that tenant moves out, you're out of luck till your next tenant moves in. With multiplexes, you have, because you've got multiple tenants, you always have that buffer. Also, the potential value add. A lot of times when you buy a property, one way or the other, there are ways that you can add value. Hence, you can value income. You can add income to that, investment. And it's more insulated when you have several units in the building. As I said, your vacancy of the total building is quite unlikely. You may have one tenant in between that you may run it vacant, but that would be on one isolated unit. And in a sense, you have 100% of potential rent generated will be added to your income for purpose of mortgage qualification. There was a time that and Chris can touch on that a little bit more, that only 50% of the income generated on the multiplex could be used for your income for purpose of qualification for the mortgage. But I know in some some cases you're able to do at 100% rental could be added. So these are all the pros that you may have. Now you want to move on to the next one, which is the cons. The cons of the capital that you need to get into multiplexes are a lot more than what you will get into a condo, obviously. So, and that's as far as your initial deposit is concerned. But also, if you're adding value to the property, that's the value that's the fund that you would need to have, either in terms of more financing, or you need to have cash up front to be able to do that. Another thing that it's for some people, it's not a cup of tea for them. It's dealing with tenants, more tenants, more responsibilities. And versus condos, everything outside the wall to wall of the interior is managed by your management company. However, in multiplexes, the exterior of the property, roof, windows, grass, and snow shoveling, and all the rest of, and everything in between is the responsibility of the landlord. So that's something, and there are times that you can allocate some of that to tenant at a cost, but majority of the time, that's something that landlords will take on. And with having multiple kitchens, multiple bathrooms, so it's something that you have to either have a property management, or you have to be up to it to have it organized in a sense to be able to attend to all the maintenance that it may require. And it's more of hands-on. Unlike condo, that quite often you do not even get to see the tenant. And when they are there, majority of the time, it's a single professional, maybe a couple. You don't even get to know the tenants because the rent check comes in and it's hands-free. Houses or multiplexes, it doesn't work that way. You're a lot more hands-on with managing the tenants, especially if they are shared spaces or common elements that you're all sharing together.
And oftentimes, a lot of times, people, if they're not up to the full-time work that comes with the management of a multiplex, but they're still interested in doing something like this, then you'll see them opt in for a property management company. So that's something that we see commonly as well.
Which we offer to our clientels. Now, one of the, next slide. So now going to the government policy, Daniel, you want to take that up?
Yeah, so if you've been following along just how the housing plan and some announcements that have been coming out over the past few months to a year, government bodies are really getting behind multiplexes. They're really getting behind densification and incentivizing builders, whether they're small or large, to get into densifying the city to try to solve the housing supply shortage that we've been facing for such a long time. One of these solutions that have come out recently is the mortgage loan insurance, which Chris, maybe we could touch a little bit on later on. But this is a multi-unit MLI Select program. This product offers scaling flexibilities to encourage preservation and creation of affordable, accessible, climate-compatible units. And it's basically a mortgage program to incentivize people to get into the multiplex space. Did you have something to add, Ari?
Yeah, I was going to say with the CMHC, what they're offering for a 5-plex or more, you're actually able to get a really preferred rate, 50-year amortization, and I believe, if I'm not mistaken, it will be with a 10% down. You can get the construction costs. It's a lengthy process, which I have seen a lot of other players that have come into the market to be able to somewhat match it or make it easier, and more accessible to investors. But that's something that it's at your disposal if you ever want to use it. There are criteria that you need to match. One of them being a senior housing. It has to be built for senior housing, or it needs to be low-income housing, or it has to be energy efficient housing. So what about financing existing 5-plexes? You will be able to, if it's a 5-plex, and you would be able to take advantage of that CMHC if it's a 5-plex. In a sense, you can apply for it. Yes.
Mm-hmm. And then in recent weeks, in the past couple of weeks, the Canada's housing plan had come out, which a section of it, which was very intriguing for multiplexes, is this section over here, which they're really trying to incentivize density in existing homes. So this paired with the Housing Accelerator Fund, they are really trying to encourage new opportunities for homeowners to redevelop properties to add densities, whether it's adding a secondary suite like a basement or converting a small bungalow into a triplex to be able to fit more families in one area. This is something that is new as part of the Canada Housing Plan. Now, what we're taking from this and what the professionals are hinting at with this is that we may see something similar to the CMHC loan for something like triplexes or small bungalows. We will see how this rolls out if there's going to be any kind of program like that. But they are really trying to target changes for mortgage insurance rules for densification. So all governments and bodies are really behind trying to densify this country to be able to spoil the people that have been coming here.
Real world examples. So let's jump into this. We're going to go into an example of a property we purchased for a client. We're going to show you basically what the, before repair and after repair, what the cap rates look like and so on and so forth. So here's a property, semi-detached, 3 units, basement, main floor, and upper floor. When we're talking about, what's been converted in terms of value add opportunities taken on, this type of home, main was converted from 1 bedroom to a 2 bedroom. We're going to get into the rent rolls as well. Basement was converted from a studio to a 1 bedroom, and we'll jump into those rent rolls now. So before rent roll, for a property like this, basement was bringing in about 1,100, main was bringing in 1,900, upper was bringing in 2,500. Total rent roll equal to about $5,500 a month. After rent roll, after repair, after basically it was improved, total rent roll jumped up to about $6,800 a month, almost about $14,000 more, per year, essentially. Basement jumped up to 1,900, which was converted to a 1 bed from a studio. Main floor jumped up to 24, which was converted from a 1 bedroom to a 2 bedroom. Now, on a property like this, when we're talking in Toronto, I would say your average cap rate for semi-detached, detached, 3-unit triplex, you're probably looking at about 4 to 4.5%, I would say. Now, what we were able to do with this type of home is we're able to jump up the cap rate to about a 5.9, almost a 6% cap with our after repair value. Property tax, we're looking at $4,357. Our rate calculation, minus our net operating income divided by the property price is basically what the cap rate is and what we came up with. Right. Any questions? Anything you guys want to add on to that before we jump into Chris?
No, I think, looking at the property, sometimes you can't judge the book by the cover. You will see it, you will look at a property. It may be not in the best possible shape, but if you go with that lens and look at it that, okay, so how I can improve it and bring revenue on that property, and would it work best, in terms of the money invested? Quite often, a lot of properties have got potentials, but it's just a matter of the person who's looking at it to be able to bring those values out.
Yeah, and just to jump in on this point here, where we're talking about different types of value add or multiplex opportunities in that sense. If you're one of those investors who maybe you've got essentially a portfolio right now, maybe you have condos in your portfolio today, maybe you've got townhouses in your portfolio, but you're looking for how to generate more revenue from your properties. This is obviously a great avenue to go down, and you've got multiple streams of income. Now, back into here, if you're getting into turnkey properties, if you're getting into stuff that was built brand new, and was just completed brand new, then your price tag to get in will be substantially higher. If you're getting into properties that are older and then you're adding value to it yourself, you already have that lift when you add that value to it with that after repair value. But obviously, you should know somebody in the construction space, or we have contacts as well that you'd be able to use, because it's not, a piece of cake to get into that in that sense. It's definitely not hands-free. And then if you're going to be doing basement finish or a secondary unit, that's a pretty basic one. You want to make sure that the property that you are looking to buy has a separate entrance to that basement, so that you can finish that up if it's not already finished.
That's it. Awesome.
So we will give it off to Chris now to talk about multiplex when it comes to financing.
Thanks very much. Maybe before I've got a couple of slides that I'll pop up on the screen just as a segue, particularly on that conversion front. One of the barriers can often be, well, what if I don't have the capital, right? I want to buy a bungalow and turn it into a duplex, or I want to buy a single family and turn it into a triplex, much like the example that was up there, right? It was clearly had been a single family home once upon a time. One of the kind of best kept secrets, I guess, from a mortgage financing perspective is there is financing available for those kinds of conversions. We call them progress draw mortgages or construction mortgages, where you've got to have enough capital to keep the project moving, but where you fund a portion of the construction, of the work, of the conversion, and then the bank reimburses you and you achieve certain milestones, and then you fund some more work, and then the bank reimburses you once you achieve certain milestones. So if you've got, let's just pick arbitrarily, a $400,000 renovation required in order to convert the property, and you've got a couple $100,000 of dollars available, it's the kind of thing where we can build a mortgage advance schedule to A, help you acquire the property, and then B, fund that work, so that at the end of the process, or at the end of the project, you've got your fully functional, ready to occupy, improved property, but you haven't had to deploy all your capital, or if you don't have sufficient capital, you've been able to roll that into your financing. I'm just going to jump over and share my screen here with a couple of slides. Bear with me a quick sec. Here we go. So just kind of jumping right in, there are two paths that your financing can take, dependent largely on the property that you choose, and to a lesser degree, how you choose to own it. I'm not going to read all the bullet points, but in the context of big bank financing, really the magic number is 4 units, that line between 4 or 5 unit multiplex. With 4 units or less, you can generally avail yourself of residential, or what we would consider to be kind of mainstream mortgage financing rates. The same kind of rates you'd get if you were buying a single unit, a single occupancy condo for investment purposes. The keys in this realm, in the multiplex context, is that the property can't have any business activity. So think, 3-unit multiplex on Main Street with some ground level retail. Your lender's going to push you into the commercial stream. Any kind of business activity there requires financing through a different lens. The advantage of taking this kind of approach is you can stretch the loan repayment out over 30 years as regulated by the Office of Superintendent of Financial Institutions, which ultimately helps drive your payment down. So lower interest rate, longer amortization, drives your payments down, ultimately supports the cash flow math, right? And ultimately, working towards that cash flow neutral, cash flow positive, hopefully once rates start coming down. And these properties have to be zoned for residential or multifamily. Some mixed use zonings, commercial zonings, those kinds of things, again, are going to get in the way here. And the big advantage that I see in doing this kind of financing for folks on a regular basis is, especially with high rates like we have today, if the loan doesn't properly service, in our lingo, or if you're not sufficiently cash flow positive on a standalone basis for the property, we can bring in your personal strength, your personal income, your personal investment assets, those kinds of things, to help support the overall quality of the deal, or support the overall debt servicing, in order to make sure that the financing works. With more than 4 units, or with any number of units with a commercial or a retail component, non-residential zoning, you could also avail yourself of commercial financing. Here it's a totally different lens. Generally speaking, the property on its own, on a standalone basis, has to be able to support the debt. And so typically what commercial lenders are looking for is they're looking, and this you'll see on the left-hand side of the screen, that DSC, debt service coverage, is they're looking for your rent roll to represent at least 1.25 times all your operating costs. So that's mortgage principal, interest, taxes, maintenance, insurance, utilities, all those bits. And so with that test, plus shorter amortizations in the 20 to 25 year range, plus typically higher interest rates. Commercial loans typically cost you about 1.5% to 2% more on a nominal basis, right? So if you were borrowing personally at, we'll just round it off at 5.5%, then in a personal context, then a commercial loan on, for a similar property is going to run you in the 7 to 7.5% range. So those three things together, interest rate, shorter amortization, and that debt service coverage requirement, typically means you can borrow less, and then therefore would have additional down payment requirements. And then that last bit, the strength of your personal finance, is typically less relevant in this space. A couple other important considerations when we think about investment real estate in general, but particularly that I think tilt the scales in favor of the multiplex kind of investment. In 2022, the federal banking regulator very quietly announced a change to financing guidelines for investment real estate. And in spring of 2023, right about this time, in fact, implemented a guideline, an amendment to federal banking regulation that requires a federally regulated lender, so think of your big banks, to limit investment residential real estate, so real estate that an investor might hold that is deemed residential, to no more than 5 mortgages. That's not 5 per institution, that's 5 total. So if we were looking at a request and somebody had 6 investment properties, 6 pieces of real estate, all with financing, and they had them for 10 years before this new regulation came into play, as a federally regulated bank, we wouldn't be permitted to lend for number 7 or even to refinance number 6. So one of these measures that's been implemented to target kind of how much housing stock investors could accumulate. And so, while we don't love it, we got to play by those rules. And so where I love the multiplex opportunity here for an investor is this is based on, civic address or a legal property address. And so 5 multiplexes with financing at 3 units a piece, I mean, you can do the simple math, gives you a rental income stream of 15 units. Right? So it's a great end around these regulations to allow you to kind of level up in terms of volume of tenancies, which of course does 2 things. 1, just provides more income streams. 2, gives you a lot more diversification and then therefore less reliance on any single tenancy, right? Somebody does some damage to a unit, you've got 14 others to buy you the time. Market is down when you need to rent one, you've got 14 others paying the bills. On the flip side of the page there, and we talked about this a little bit already in the context of how kind of that debt service coverage works, and then maybe just quickly, when we are borrowing in the personal context, the target is all of your financial obligations, including the property expenses and financing for the new multiplex, get thrown into the recipe with all your other personal financial obligations. And then we look at all those as a percentage of your total income. So the income off the new property, plus, as I mentioned earlier, the income that you bring to the table from your other rentals, from your day job, from your investment portfolios, any income source that you would be required to pay tax on is in play to help bolster your financial strength. And then lastly, very quickly, especially with the additional nuance that comes with this kind of investment, right? There's some sophistication there. Really important, I think, to follow a rigorous process so that you've got your ducks in a row. First and foremost, right? How much can I afford, right? Not only in terms of absolute purchasing power, but where it's appropriate to use debt to acquire the asset. How much am I going to qualify for in terms of financing and through which path, right? Then crunch those numbers along with your Zadigan Group realtor to make sure that ultimately the model you're looking to achieve, that cap rate, to Jonathan's earlier point, is achievable. Then hit the ground running, right? The hunt is on. And then lastly, of course, one of my all-time favorite Motown tunes, signed, sealed, and delivered. I'm going to call it there, but I'm certainly happy to dive deeper in the Q&A.
Thanks, Chris. Okay. So if we have any questions, that's the gist of the multiplex. Now, obviously, it's important to understand this is not a beginner investment type. This is certainly intermediate to advanced, depending on which scale, which type of multiplex you're getting into following this scale here. And a lot of mistakes can definitely be made, costly mistakes, if you're not having the right guidance and the right team behind you. We've done this for ourselves as well as clients. We've assembled a great team, Chris being one of them on the finance side, as well as contractors, zoning people, to be able to try to get things as smooth as possible for anybody that needs this type of investment. So we'll open the floor for any questions and closing remarks.
Go ahead.
Yeah, just to piggyback on that, when getting into any real estate investment, I would say, especially of this magnitude, I would say it's extremely important to assemble that team. So the first place that you should be looking is assembling that team. The real estate broker or agent you're working with, the financing that you're working with, the contracts that you're working with. You want to have a pretty good layout of how it'll turn out, what your in is, in terms of capital, as well as what your out is, if it's going to be a flip or if it's going to be a, keep and keep it as a cash flow for you for long term. But that's really, really important, is having that team behind you. Then they're going to be able to give you that advisory on, these are the next steps, this is how you're supposed to do it, and this is how you can scale that portfolio.
Yeah. Question for you, Chris. In terms of the construction financing, like how long should they allocate? Like if somebody is in a planning stage and still in the design process, how far in advance should they apply for construction mortgage?
It's a really important question, and there is two parts to the answer. So I'll start at the end. In the end, construction financing is only considered on the basis of architectural drawings, full specifications, and a construction quote.
Okay.
So as it relates to approval, you can't be kind of locked in and known around your construction financing until you're already committed and well down the path. And so it's important to know then, okay, well, absent the kind of multi-stage rollout of the loan, how much would I qualify for in general? And so what I tend to do with my construction clients is we start with a very vanilla pre-approval, right? Because the qualifying metrics are the same. How much is the final amount of the loan after everything is all said and done relative to the expected final property value? And then all of that is stress tested through the normal stress testing qualification process. And so we know, okay, if I'm going to buy for, let's pull some of those numbers out of the example. If I'm going to buy for 1.1 and I'm going to put 2 into it and I'm going to have a final value of 1.3, how much financing could I be approved for in that context? Could I be approved for 80% of 1.3? If I could, then we know that the qualifying math is still there. And then it comes down to, there are still plenty of nuances. Do I have enough liquid cash available to fund the work partially and then claim back from the bank? Do I have a strong enough personal covenant? Do I have a good credit rating? All those things we can assess at pre-approval stage. So we know, at least in principle, okay, the buyer, the borrower is financially strong enough to support the construction loan, even though we don't yet have the approval of plans and specifications and contractor and those kinds of things quite yet.
Awesome. And one thing I want to say, as large as of a commitment the multiplex may look like, whether it's a secondary unit or a triplex or fourplex or 5plex or more, there is always that option of joint venture with someone else. These are like big undertaking, and sometimes it's to in a sense to curb the risk and to get yourself familiarized with the whole process. It may not be a bad idea to get into a joint venture with someone of an equivalent, either bringing the skills. There should be obviously a trade-off for going joint venture with someone. So they bring their own sets of values on the table. So collectively, they could walk into that path, and eventually they would be at a point. Because I remember I helped out two young friends that they could not do a property on their own. So when they came to our office, we did a joint venture with them. So they purchased a property of, single family. They converted, they added the secondary unit, rented it for a year. They made quite a bit of money. That gave them enough of cash in hand so they could go separate ways. And each one of them right now, they have their own homes. So you got to start from somewhere. Yes, it's a big undertaking, but you can chunk it up or you can share it with somebody else to take you to the next level of investment.
See it all the time. Exactly like that, where friends will go in together. Maybe they stay in their personal names. Maybe they set up a holding company. Yep. We did a transaction last year for 3 couples who all went in on their first with big aspirations. Yeah, it's a great approach to get started.
100%. Well, thank you very much for your time.
Chris.
If there is not any other questions, we can wrap it up. Thank you for your time, and thank you for all the details, information that you brought on the table.
Thank you, everyone.
Thanks, everyone.
Thanks, guys. Enjoy the rest of your evening.
Thank you. Take care. Bye-bye.